Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for Friday, 14th of May. My name is Carl Capolingua. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be with you as we check out all of the big broker moves for last week. We'll do that after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees. Four fantastic reasons why your next ASX share trade should be with Think Markets. And if you're new to the Think Markets family and you'd like to join us and get trading before June 30, your first 5 trades are for free. There are some terms and conditions, so check the website for further details. As suggested, we'll check out all the big upgrades, downgrades, price target changes, and a few feature stocks today. We'll kick off with the ratings changes. First up, upgrades. Now, don't forget, each broker has a rating system, basically buy, hold, or sell for the stocks that they cover, and a price target system where, based upon their valuation, they'll specify a price that they could see getting hit in the market over the next 12 to 18 months. Looking at that list, we can see that JP Morgan has upgraded Crown Resorts from a hold to buy, also increased price target a nice whack from $11 to $15. Now, that is an increase of 36.4%. And based upon the current price, it means there's still about 15% upside between that current price and the specified target. They said they were working with the Independent Liquor and Gaming Authority in a bid to get their licence for the new Barangaroo Casino in Sydney authorised. They had made significant concessions. Also, interestingly, this week, quite a bit of activity on the corporate front where Blackstone Group increased their bid for the company. Crown is currently under a takeover from Blackstone. The original bid was $11.85. They increased that, just checking my notes here, to $12.35. Now, that's an all-cash offer. And in the meantime, Star Casino Group has lobbed in a merger proposal, which is 25% cash at a price of $12.50 share, and the rest in Star shares. Values the company all up at about $10.98 a share based upon current share prices. But the brokers are out this week and sort of working out what the synergies would be, and therefore what a combined entity would be worth in the market. They reckon it could be worth up to $14.50 a share. That's an estimate that came from Macquarie, and JP Morgan, their commentary and the reason for their upgrade was mainly based around the fact that management has been very quiet about this bid so far, and they took that as an indication that management would hold out for higher bids down the track, and hence the increase in the rating and the price target there. Looking down the list, Orica also in the news this week. They released their half-yearly profits, slashed in half pretty much. Profits down about 53.6% on an 8.9% fall in revenues. Company struggling at the moment. The coal industry is one of their major customers, and coal exports have been negatively impacted by some of the tensions between the Australian government and China over the last 6 months, where China stopped taking certain types of coal. Now, they have been able to redirect some of that coal into India, and of course now we've got this huge COVID problem in India. So things not so great at Orica, but Citigroup choosing to look past the valley to the other side, and they did predict some significant growth there, hence the upgrade in the rating, but also the big downgrade in the price target is explained by some of the problems they're having. They're still seeing about 11.4% upside in the price. Regis from Macquarie, they went from neutral to outperform with a very large price target increase and effectively still seeing about that much in terms of upside. Macquarie said that it had upgraded its forecasts after the additional funding announced by the Australian government in response to the report by the Royal Commission into Aged Care and Safety. Looking into the list of downgrades now, CSR, they actually reported their full year results, which were quite solid, but Credit Suisse noting a combination of below expected revenues and the fact the share price has done really well, and therefore feeling that deserved a downgrade from outperform to neutral. They did increase the price target, though, on the back of what was some pretty solid results by 7%, and they think it's pretty fully valued, hence the neutral rating. Down the list into Suncorp, they had some news out during the week where they announced their 3-year general insurance plan that included a margin target of between 10 and 12% by FY23. Wasn't enough to stave off a downgrade from buy to neutral from Citigroup, but they did upgrade the price very slightly, and they still see a decent whack of upside there. A2 Milk Company, also in the news, it downgraded its earnings estimates for FY21 for the fourth time since the beginning of the pandemic. Brokers are frustrated, investors are frustrated, and the share price is plummeting. Macquarie downgrading their rating from neutral to underperform and slashing their price target, really slashing it by 42%, and still thinking, even with that reduced price target, that the company is fully valued. Brokers quite negative on that one, and it is one of our featured stocks today, so we'll discuss it a little later on in the presentation. For now, let's look at the price target increases, so no rating changes here. Commonwealth Bank, they recorded their third quarter trading update. Things going quite well. Modest revenue increase, modest cost decrease. They also noted that the credit quality of their loan book continues to improve, as does their capital position, and some fairly positive comments also there from CEO Matt Coman. Led to 3 broker upgrades in their price targets, and by fairly significant amounts here, 11.8% at Credit Suisse, 15.2% at JP Morgan, 5.5% at Macquarie, but each of those brokers feeling that the stock is quite fully valued at the current time, and that would explain their fairly neutral stance in terms of their ratings. Mentioned CSR earlier on. They had quite a solid set of profit results, with net profits after tax up 17%. But as we mentioned before, a miss on the revenue side of things, that was down about 4%. They said otherwise things were going quite well for them, and plenty of cash going through the business, which allowed them to declare a 14.5 fully franked final dividend for the year, taking the total annual dividend amount to 23 cents fully franked. And that doesn't even include a 9.5 special dividend they paid early in the year, and that is well up from the 10 cents they paid the prior year. Crown, we've already talked about what's going on there. Goodman Group, they had a third quarter trading update and also reaffirmed their full year profit guidance forecast of $1.2 billion, noting that that would give them a total of about 12% growth for the full year. Into the next page now, Macquarie. These are updates from Macquarie's full year results release, which occurred on Friday last week. So these were coming through on Monday. Fairly well received by brokers more generally. This is one of our focus stocks, so we'll check out those recommendations a little bit later on, but not enough to stave off a retained sell rating there from Citigroup. They did increase the price target by 12% and just very small tweaks to the price. Otherwise, the most bullish broker there, Morgan Stanley, with a 10.2% upside and an overweight rating. A nice price target increase from Citigroup on Oz Minerals, but I would suggest that's just catching up to recent share price movements. Into the next page, REA Group. They reported March quarter revenues, which were 13% higher, which pushed EBITDA up by about 10%. Listings were also strong, up 8%. Macquarie said, however, that they believe that growth may well moderate through May and June. On the other hand, UBS and Credit Suisse said that they both expected continued growth, and Credit Suisse saying that listings could increase by as much as 20% in the second half. Looking down the list, we've already discussed the Regis price target change there. Sandfire's just really a catch-up to the recent share price moves from Credit Suisse. Otherwise, fairly modest moves until we get to Xero. Now, they announced their full year 21 results. So revenues were up 18%. Subscribers were up 18%. Most brokers viewing this as a very, very strong result, hence those price target increases, 13% at JP Morgan, 8% at Macquarie and 2% at UBS. But brokers also pointed out that the rate of growth appears to be slowing from the previous half and also previous financial years, and costs were also on the increase as well. That would probably explain the negativity in some of these ratings. So lighten, neutral and sell respectively from JP Morgan, Macquarie and UBS, with really only Macquarie seeing some upside from their price target, and that contrasts starkly with significant downside seen by JP Morgan and UBS. Xero, one of our focus stocks, we'll check out that a little bit later on, as we will A2 Milk, but the news, of course, was their massive build in inventories as the pandemic continues to negatively impact those Daigou sales, that is sales of Australian branded products into China via various avenues. What's been saving them a little over the last 6 months was their Chinese branded sales have been doing very, very well, but there was a marked slowdown in the rate of those sales in this update. And as a result of those slower sales and sales growth more generally, they have seen a massive rise in inventories, which means price discounting and also, in some cases, having to replace inventory that has been sitting on stocks at various suppliers. And the company took a substantial provision on the back of that. Brokers very negative across the board, saying that many of these issues would probably continue down the track rather than seeing some of these pressures alleviated. So look at the price target decreases there, 18% from Citigroup, maintaining a sell. Credit Suisse down 30%, and they still see 10% downside, maintaining their underperform. Macquarie down 42.6%. Companies currently fully valued, underperform. Morgan Stanley down 35% on their target, but still seeing some upside. Really the most bullish broker there, but the rating is only as good as equal weight. Incitec Pivot, they're still having lots of problems at their Waggaman plant. That is causing further delays and profit downgrades. Hence, we're seeing some tweaks to the price targets here. Brokers still fairly bullish on it. Compare those price target upsides and ratings to A2 Milk, for example. Orica, we talked about before, they're having some struggles at the moment. And look, the rest of them are pretty modest in terms of the magnitude of price target changes. Into our focus stocks, we've talked about the troubles at A2 Milk. We've talked about the fact that things could get worse. Citigroup saying margins could get worse there, as could competition. So I guess one of the other problems is that their Chinese branded products, as I said, sales have been declining because Chinese customers are diverting sales to locally produced brands, which is interesting because the whole reason for A2 Milk's success was this trust factor. So if that trust factor advantage is being eroded, then it really makes you wonder how they are going to grow that business going forward. Citigroup said that they agree with management that drastic action must be taken to address those inventory issues we discussed earlier, where they will be replacing old stock on shelves and destroying that old stock. Credit Suisse said that the impact would be long-term and significant going forwards due to competition, permanently reduced Daigou sales. The hope had been they would bounce back, and structural headwinds such as slowing birth rates. Macquarie said that they are not impressed with the company's fourth downgrade since the start of the pandemic. Really, management should have been able to foresee some of these issues. The impact of excess inventories and lower pricing are likely to persist longer than the company anticipates. And then Morgan Stanley, who we know is the most bullish of the brokers surveyed, they said that China label sales appeared to be slowing, reversing previous strong growth. In addition to inventory and margin issues, the broker is concerned about a prolonged negative impact on earnings. Having a look at the average consensus there, we are at a hold, which is interesting because I would expect it's very close to a sell, given that we are at one strong buy, no buys, 4 holds, 4 sells, and 1 strong sell. Quite concerning. Looking at the numbers, look, again, probably these will need to be updated, but on the face of what we can see at the moment, that is average in terms of the broader market. The PE is high for a company that doesn't have any growth and is not likely to have any growth for the foreseeable future. The company has stopped paying dividends due to their problems. Price to free cash flow is not terrible, not great. The return on equity is historical. It has been fantastic, but I don't think we're going to see these jumps that are predicted here. I think those numbers need to be updated by the brokers. In terms of the mean price target, we're at a 7.11 at the moment, but I would expect some of those to come down as some of these updates come through. The chart looks horrendous. We've gone for a weekly chart this time, and we can see that there's not a lot of support kicking in until we get to around this sort of 230, 250 level. I can't see anything on the chart to suggest that we won't get there. I mean, we've broken through this key support here. We didn't even try to get back up and test it. Very shallow rallies, if and when they occur, and there are so many black candles here, gaps to boot, and there's really not a lot of redeeming features for that chart. So if you ask me if we should run out and buy this one yet because it's quote unquote a bargain, well, I would suggest to you that the brokers don't think it's a bargain. None of the fundamentals would suggest it's a bargain, and the chart certainly doesn't suggest it's a bargain. Now, harking back to the turnaround stocks webinar we did a few weeks ago, this was one of the ones we covered, and off the top of my head, and you'll have to go review that webinar to get the exact number, but I'm pretty sure I said this stock won't be a bargain until we get below 360, and there's every chance that we could get there. Now, I came up with that valuation on the basis of the fundamentals that were in place then, and perhaps even I would have to even downgrade that value based upon the recent developments. Next stock is CSR. Stark contrast in terms of its chart. We can see that this one has a well-established short-term uptrend and a very well-established long-term uptrend. Way more white candles, but I'm a little bit concerned about what's going on here at the end. This big shadow is not great. It points to significant supply in the market, and these black candles tell me that supply is definitely there and potentially building. So that one is a little bit of a question mark for me. I certainly wouldn't run out and buy CSR given what's going on with the candles. But if I had it, I think there is a strong argument for holding given the strength of that current trend, but it's certainly on watch. Brokers broadly positive towards their full year results. Credit Suisse noted excellent progress on costs, and that was a pretty consistent theme through these notes here. Another consistent theme was that the valuation is potentially stretched and that the company is at the top of the cycle in terms of its earnings. We can see Morgan Stanley saying the stock is fully valued, but as is the case with broker research, there's always somebody with a contradictory note, and it was Macquarie saying that they don't think the valuation is particularly stretched. There you go. But for the most part, we did see price target increases, and don't forget there was that downgrade in the rating from Credit Suisse. On average, brokers are at a hold, but at least we do have some strong buys and some buys in there, 3 holds and some sells. We've got a mean price target of 550, which will notch higher because of those price target upgrades, probably closer to 6, but showing that the company is fairly fully valued. In terms of the fundamentals, that is certainly way better than the market average. The PE is not as good as the market average, and the PEG is above 1, which indicates there's not enough growth to potentially justify that PE. Dividend yield is very good, however, at 4%. Price to free cash flow is very good. Return on equity is above average. I would certainly give this a very solid B. I'm disappointed by that, and with the question mark over this, I can't suggest that you run out and buy CSR at this stage. But as I said before, if you've got it, you might want to hold it. Looking at another very strong chart, Macquarie Group here. Fantastic short-term uptrend, fantastic long-term uptrend, lots of white candles. Look at all these little white candles. A little bit concerned by this little dip since the results, but look, I think it's holding really well. And today, a nice pop-up here back above that short-term trend zone. So I would certainly stick with this one. Brokers were broadly positive on their full year results. Some of them questioned, however, the valuation. Citigroup saying it's too high. But the feeling, I would say, was generally that operating conditions are strong currently and will remain so going forward. There are some challenges out there, but brokers tend to cover themselves by saying that. JP Morgan here with continued growth expectations and potentially share price growth. Morgan Stanley noting the broadness of group strength and potential growth opportunities ahead. On average, brokers quite positive towards this one. Certainly compared to the last two we looked at. Strong buys, 2, 6 buys, 2 holds, and 1 strong sell, maybe a bit of an outlier there. Mean price target, again, will notch higher, but gives us at least a little bit of upside. In terms of the fundamentals, enterprise value to revenue is high by market average, but not inconsistent with the financial services stock. The PE is not exactly screaming cheapness here, and the growth is not enough, I would suggest, to justify it with a PEG of 4.2. Dividend yield is quite attractive at 3.5. Price to cash flow, quite solid. And return on equity, not sure what's going on there. Might be a throwback to some COVID numbers. But putting aside this one, probably a B, maybe a C+. maybe a C+. So, yeah, look, fairly average there. A tick here, a tick here. I'll let you decide whether you're comfortable with 2 out of 3. Final focus stock today is Xero. They had a great set of results, but those results did demonstrate some slowing growth. Management said they weren't too concerned by that slowdown in growth because they are investing heavily in R&D, in sales and marketing to grow the business into the future. But investors were a little bit more concerned. JP Morgan noting that whilst revenue was slightly ahead of expectations, expenses, particularly relating to admin, marketing and R&D, were concerned, and that caused EBITDA to miss their estimates by around 20%, which is a pretty decent miss and perhaps explains why we saw such a large drop in the share price on the results release. Macquarie said that they would look past the short-term blip in costs, assuming that growth can return to pre-pandemic levels, but still only a neutral rating from them. And then UBS, they are the most bearish. They have a sell rating at the moment. They said that the valuation remains significantly elevated despite a solid set of results. Otherwise, UBS quite positive, noting strong subscriber growth and revenues, structural tailwinds, and sound management, all positives. But rising costs, a key negative. About an average of a hold in terms of ratings: 1 strong buy, 5 buys, 4 holds. I don't like seeing 4 sells. Beauty is in the eye of the beholder, and it bothers me that 4 beholders really don't like this one. Mean price target of 124.63 again will rise, which actually gives us some upside given the recent falls. That's interesting. In terms of the fundamentals, this is too high. This is way too high. This is great, but I don't think it's enough to justify this. It's not coming down fast enough for me. No dividend yield. They are reinvesting cash flows back into the business. This is too high. This is good, but not enough, I think, to justify the valuation. So I'm going to give that a C at best. This is a question mark, and the chart is looking quite bearish actually with this broad double top pattern. The short-term trend has turned down. We've broken below the long-term trend support. It should be support. It hasn't happened. We've got some really bearish candles here. That black one with a long upper shadow points to massive supply in the market, and there wasn't a quick bounce. In fact, it was followed through today. It's quite concerning. I think we will see 104.44, and if we break that, then it could be a slippery slope from there. So on that basis, I wouldn't be buying this one. Well, that's it for today's session. You can catch all of our other market updates in our market news section of the website. You can follow me or the Think Market handles if you like on Twitter. Head to the webinar section to register for next week's webinar. It's going to be an absolute ripper. Top 3 ASX stocks under 30 cents. And then a week after that, we'll have Ask the Experts and then how to use price action to spot trading signals. The disclaimer before I leave you today says that everything we've discussed is general advice only. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposits. So before acting upon any of this information, make sure you understand this disclaimer or give us a call if you have any questions. Thanks for joining me today. It's been a pleasure chatting with you. All the best for your trading. Until we catch up again, bye-bye for now.